Today, we need to address a subject that is dominating headlines, social media threads, and investor discussions across the precious metal space. The claim is simple, dramatic, and emotionally powerful, that banks are on the verge of collapse because of massive silver short positions, and that the silver market itself is about to break. If you spend any time on X, YouTube, or Substack, you have likely seen these arguments repeated again and again. Banks are allegedly trapped. A historic default is supposedly imminent. The paper market is said to be moments away from failure. In this analysis, we are not going to dismiss these claims emotionally, nor are we going to amplify them irresponsibly. Instead, we are going to slow this conversation down and examine it structurally. Silver is one of the most complex markets in the world, and oversimplifying it is exactly how credibility is lost and capital is misallocated. Before we go further, it is important to clarify one thing clearly. Believing in physical silver does not require believing that banks are about to collapse tomorrow. These are two separate claims, and confusing them weakens both arguments. I am firmly supportive of physical silver ownership. Physical silver exists outside the financial system. It does not rely on the Federal Reserve, on government legislation, or on counterparties honoring contracts. It simply exists as metal. That independence alone is what gives physical silver its strategic value. However, none of that requires us to assume imminent systemic failure. Strong conviction does not require exaggerated narratives. One of the most common talking points today is the idea that silver prices have decoupled, that paper silver prices in New York and London no longer reflect real physical silver prices in Asia and the Middle East. According to reports circulating in early 2026, futures and spot prices remain in the low to mid-70s per ounce, while physical silver in certain regions is reportedly trading near or even above $100 per ounce. If that were a direct comparison of equivalent products under identical conditions, it would indeed be alarming. But the first responsibility of any serious analyst is to ask a basic question. What kind of silver, under what conditions, at what scale, and with which constraints? Silver has never traded as a single global price. The price most investors see on a screen is a futures-derived reference price. It is formed in highly leveraged derivatives markets, such as COMEX and the London OTC market. These markets exist primarily for hedging, financial settlement, and institutional trading, not for buying coins or small bars. Physical silver operates under completely different constraints. It must be fabricated, transported, insured, vaulted, and delivered. Those frictions matter. When reports claim silver is trading at $120 or $130 per ounce in Japan or Kuwait, those prices often reflect retail transactions, small bar sizes, local taxes, immediate delivery premiums, or regional shortages. They do not automatically mean the global silver price mechanism has failed. That distinction is critical. Rising physical premiums tell us something important, that physical supply is tightening, but premiums alone do not prove systemic collapse. This is where many narratives lose discipline. Some commentators leap from premiums are rising directly to banks are insolvent. That conclusion is not supported by verified evidence. Now, let's talk about where the stress actually exists, because stress does exist. Volatility in silver is real. Regional scarcity premiums are real. Industrial demand growth is real. Declining inventories are real. But stress does not equal collapse. To understand why the banks are trapped short silver narrative is widely misunderstood, we must understand how the paper silver market actually functions, not how it is portrayed online. Most silver price discovery happens in derivatives markets. Futures contracts represent promises, not metal moving hand to hand. Banks participate heavily in these markets, and yes, they often appear net short. But being short in a derivatives market does not automatically mean speculation. Banks primarily act as intermediaries. When mining companies hedge future production, banks take the opposite side. When industrial users want price certainty months in advance, banks again sit in the middle. This is market making and risk transfer, not directional betting. Commitment of traders reports show gross positions, not full risk exposure. They do not reveal physical holdings, OTC swaps, client offsets, or option structures. Interpreting those reports without context leads to misleading conclusions. The real vulnerability in the system is not short positions themselves. It is delivery stress. COMEX futures are theoretically deliverable, but most contracts are settled financially or rolled forward. The system functions as long as physical supply remains available when demanded, and confidence remains intact. Over recent years, registered inventories have declined. LBMA vaults have seen withdrawals. Industrial demand has continued to expand through solar, electrification, defense, and data infrastructure. These are observable facts. However, declining inventories do not mean zero inventories. The metal still exists. The question is at what price and under what conditions it becomes available. This is where markets transition from stability to strain. When delivery demand increases, exchanges have tools to prevent disorderly failure. Margins can be raised, Cash settlement can be encouraged, delivery incentives can be adjusted. These mechanisms exist specifically to avoid sudden collapse. That is why repeated predictions of imminent default have not materialized. But avoidance mechanisms carry consequences. Higher margins force leverage reduction, cash settlement damages confidence, persistent back liquidation signals scarcity. Over time, these pressures erode trust in the reference price. This erosion is far more dangerous than a dramatic failure, because it unfolds slowly and predictably. Banks are not about to implode because of silver shorts. That narrative is simplistic. But banks do face reputational and structural pressure if physical tightness persists, and confidence in paper settlement continues to weaken. Now let's shift to the physical market, where the real story is developing. Physical silver exists in vaults, bars, coins, and industrial inventories. It cannot be created electronically. And in early 2026, we are seeing real scarcity in specific regions, particularly across Asia. Reports from China, Japan, India, and the UAE indicate physical silver trading at materially higher prices than futures benchmarks. This discrepancy is driven by several factors. Regional demand is one. Asia accounts for a massive share of global silver consumption, both industrial and investment. Solar expansion, electronics, EV production, and cultural savings demand all apply pressure. Taxes and regulations matter. VAT and local levies inflate reported prices when converted to dollars. Product type matters. Small bars and coins carry higher fabrication and delivery costs than wholesale 1,000-ounce bars. Logistics matter. Physical silver cannot instantly move across borders. Shipping delays, refinery capacity, and vault throughput create bottlenecks. And finally, futures and physical markets respond to different dynamics. Futures prices reflect leverage and financial positioning. Physical prices reflect scarcity and immediacy. None of this implies manipulation. It implies structural tension. Claims that silver is really $130 globally are misleading, but the underlying trend is undeniable. Physical silver is tighter than expected. Now let's address bank exposure again with nuance. While banks hold large gross short positions, public reports do not show whether those positions are hedged. The claim that banks are naked short hundreds of millions of ounces is not supported by verified disclosures. Banks manage risk extensively. However, rising prices and tight physical supply do create pressure, particularly for liquidity-dependent strategies. Stress is present. Insolvency is not proven. Margin requirements play a central role here. When prices move rapidly, exchanges raise margins to ensure stability. This forces leverage reduction and creates short-term volatility, but it also prevents cascading failure. Retail premiums, particularly in Asia, are the clearest signal of tightness. Premiums of $5 to $15 over spot for retail products indicate real demand pressing against finite supply. Not all silver is equal. Small lot demand amplifies premiums faster than wholesale demand, explaining extreme anecdotes without implying systemic breakdown. Speculative behavior also matters. Social media narratives can accelerate physical buying, reinforcing short-term scarcity and volatility. This is not chaos. It is a stressed but functioning market, adjusting to structural deficits. For investors, the implications are significant. Physical silver remains strategically superior to paper claims. Supply rigidity, industrial demand growth, and declining inventories create long-term upward pressure. Roughly 3/4 of silver production is a byproduct of other mining. Output cannot scale quickly. New discoveries take years to materialize. Industrial demand is non-negotiable. Silver's electrical properties make substitution difficult. Regional premiums reflect real conditions, not manipulation. Structural deficits amplify volatility, making corrections normal but not thesis-breaking. As for banks, the collapse narrative remains speculative. There's no confirmed evidence of forced failures due to silver exposure. Stress exists, but stress is not insolvency. So what should investors do? Focus on physical silver ownership, understand premiums, accumulate gradually, monitor physical market signals, not just futures prices, avoid panic during corrections. The move from the low 20s to the 70s was structural repricing. The emotional phase of the bull market has not yet occurred. Higher prices are plausible, but timing is uncertain. In summary, the silver market is under strain, not collapse. Physical tightness is real. Paper markets are adjusting. Structural deficits persist. Silver may never return to its old pricing regime, and that favors those who understand the difference between stress and failure. That concludes this analysis. Share your perspective, engage in the discussion, and stay focused on structure rather than noise.
Hello everyone, welcome back today my new video and my channel Money Made Simple. So friend, welcome. I hope you all good, you all fine. So, friend, today we need to address a subject that dominating headlines, social media threads, and industry discussions across the precise metal space. The calm is simple, dramatic, and emotionally powerful. Dead banks are on the verge of collapse because of massive silver short positions. And that the silver market itself is about to bank. If you spend my time on X, YouTube, or Substack, you have likely seen these arguments repeated again and again. Banks are illegally trapped. A historical default is spadly, supposedly imminent. The paper market is said to be moments away from failure. In this analysis, we are not going dismisses the calm emotionally, nor are we going to amplify them irresponsibility. Instead, we are going to show this conversation down and example its strategically. Silver is one of the most complex market in the world, and our sampling it is exactly how credibility is low and capital is miscalculated. Before we go further, is important to carefully one thing carefully believing in physical silver does not require belief state banks are about to collapse tomorrow. These are no separate claims. Thank you so much.